Hey, what's up, everybody? Rick Dykes here with you. I am going to share with you a little something that's been on my mind. It's actually Life Insurance Awareness Month, which is September every year. This organization called lifehappens.org does this to just help raise awareness about the need for life insurance, which I know it seems like most people are aware of life insurance, but there's still a pretty significant portion of the population, like as much as 30 or 40% of people who do not have any coverage at all. And this organization does this every year to just help raise awareness of that there's a need out there. And so I'm going to share something that's just an interesting concept that I've been learning a ton about over the last couple of years, learning from some great people. And it's actually something that is tied in with a book that I've been rereading that was given to me back in college. It was given to me by a friend, Going Strong. And he gave me this book, Rich Dad, Poor Dad by Robert Kiyosaki. It's one of the greatest books ever, at least financial books ever. And I encourage anybody to pick it up. And he tells this story in a narrative form about these two father figures in his life, is actually his actual father and this other father, a friend of his father, who teach him about the concepts of money. And one has a rich dad mindset and the other has a poor dad mindset. So I'm going to tell you about the very first principle that he teaches you, and it's rule number one. He says, you must know the difference between an asset and a liability, and you have to buy assets. And he says that rich people buy assets and poor people buy liabilities. So you have to, if you're going to be a rich person, if you're going to be wealthy in your life, if you're going to be good at money, you have to know the difference. Then you have to buy assets and own assets. So I'm actually going to draw a little something here on this whiteboard for you, and hopefully this helps illustrate it. So there are these two little simple things that if you're a business owner, you're very familiar with because you follow these things religiously. Maybe you check them every day. If not every day, you check them very regularly. There's two things one's called an income statement. And if you're like me, you check this regularly because you want to know where things stand. So it's an income statement, and it's just these two little ideas. So I'm going to do a little box. So income and expenses. Okay. So that's your income statement. No, my artwork is fantastic. And balance sheet. And this is super simple. So if any accountants are watching, please don't judge me. They'll make it more complicated, I'm sure. I mean, they'll tell you the real way to do it. But a balance sheet is basically just assets and liabilities. Okay. So what Robert Kiyosaki is saying is you have to buy assets and not liabilities, because assets, how he defines it is, and this is right from his book, by the way, he uses this little diagram, but this is just basic fundamentals of accounting and business. So he says basically assets are things that when you buy them, they produce income for you. So like if you were to buy a business, for example, it would produce income for you. Okay, that's true, right? Now you buy a car, it basically becomes an expense. Okay, that's true. So anybody would agree with those things. So now you might be asking, like, what does this have to do with life insurance? Well, there's this discussion about like what kind of life insurance should you buy? Should you buy whole life insurance, which is permanent insurance, or should I buy term life insurance, which is the cheapest way to get my death benefit? So I actually ran some numbers on this that I want to kind of share with you. I'm going to go over those with you right now. These are the numbers, and I'm going to just run through those with you real quick. So first, if pretend me, who is still 35 years old, I'm not far from that, but I'm not 35 anymore, and I'm super healthy. I need $1 million of coverage. If I'm going to buy term insurance that's going to cover me for the next 20 years, which is about how long I need to be covered to take care of my family, I'm going to spend about $655 a year to get that. It's about the best price I can find. That's from a really quality company. So I'm going to be spending probably in the neighborhood of $13,000 to $15,000 a year. But term insurance is, no matter how you shake it down, it's a liability because it's just an expense. It has no cash value. It does nothing for me. It does not help me. It's no good to me. It brings nothing back to me unless I die. Then it's not even really, it's not really considered an asset at that point. it just really has done the thing that it was created to do, which is just do protection. Okay, so, but on my balance sheet, it's a liability. It's an expense that I have to pay. It creates an expense. Okay, so, but I'm not saying that it's bad, because if you need coverage and it's all you can afford, you need to get some coverage. But I just want to show you something really simple, because most people don't understand this. If you were to understand all the benefits, I don't have time to show you all this in this video. I would love to talk to you about it. In fact, I'm going to include a link in this post where you can book some time with me. We'll talk about it, and I'll share with you actually a copy of my incredible friend Caleb Gilliam's book, The And Asset, which tells you all about it. It's like one of the best things I've ever read on this. I'll actually send you a copy of it if you schedule some time with me and talk about it. It'll tell you everything that you need to know about this and asset, which is incredible. But if you understood how whole life insurance really works, you would understand that I can use it like a savings account. So instead of trying to buy as much death benefit as possible for as little money as possible, I want to put in as much money as possible and buy as little insurance, because I get tax advantages. Like if my money grows tax deferred, I get a steady rate of return, like a really solid growth in the form of a dividend from a solid, highly rated company that's been paying dividends for 90, 100 or more years. So that's really good rate of return. That's really good consistency in return and stability. And I have control over my money. So let's talk about that. So if I put in, let's just say I have $100,000 I want to save over the next 5 years. So if I'm making $250,000 because I'm performing well as a real estate agent, or performing well in my sales job, or as an attorney, or whatever it is, I'm going to save 10% of my income, and I'm going to put that into this vehicle. Okay, I'm going to put it into a great savings vehicle. If I put it into life insurance, 5, 6 years down the road, now I'm earning in dividends. I'm making $3,000, $3,700, $4,000, $4,700, $5,400. So my cash value in my life insurance, which by the way, in year 7, 8, my cash value in my policy, just for example, in the 8th year is $139,000 is my cash value in the policy. So I've got $140,000 in the policy. So I'm profitable in my policy. My life insurance itself, the death benefit itself, has cost me nothing. I'm profitable in it, and I'm earning dividends every single year from there on. So that's a win. So $3,700 in dividends, $4,000 in dividends. So if I go back to my whiteboard, which I hope you're still seeing there, I'm going to put whole life insurance right here, because every single year it produces income to me. Now, here's something that's really cool. And again, this one I don't have time to really explore with you. I would love to talk with you about it in a meeting, but my money's in there. Let's just say I've got a $100,000 investment opportunity to buy into, a rental property, or, a house that I think I can flip, or a business venture with somebody that I really trust and I think I can make some money on. Whatever the case may be, if I want to access my money, I can access it because I have full control over it. I can get to that full $100,000 that I want to access and use. So I can use my money. And here's what's crazy. So in that year that I want to get to the money, say that my cash value, out there in year 15 is $256,000. That's what I'm looking at right there. And I'm going to earn a $7,500 dividend that year. And I got $256,000. I can use $100,000 of the money, or $200 for that matter. I can use the money that I need for my investment opportunity and still earn my dividend, because the insurance company is still paying me. So it becomes an asset paying me that I can buy another asset with. I can buy real estate with it that is also going to pay me. That's why my friend Caleb calls it the and asset. It's whole life insurance contracts properly structured from dividend paying companies begin to put dividends in your pocket. And that's money that you can use today. It's not money that you have to wait for. You can use it immediately. So check that out. I'm going to put a link down below that you can schedule some time with me. I'll send you the book so you can check that out. And I would love to talk to you about how it can impact your financial future to begin buying assets, even in your life insurance planning. Would love to talk to you about that. All right, guys. See you soon. Thanks a lot.